RainFin, a fintech lending marketplace, has formed a strategic partnership with Absa to offer unsecured loans to small and medium enterprises. Joining me in studio with more detail are RainFin CEO Sean Emery and Eugene Boyson. He's Chief Innovation Officer at Barclays Africa, of course the owner of Absa. Gents, thanks both very much for coming in. So Sean, this isn't a new relationship because when you launched, Absa did have a 49% stake in RainFin. What's changing?
So I think RainFin is an important part in the Barclays Africa strategy of how they deal with innovation. They have a RISE program. How this program works is they do identification of assets, and they call it connecting. They then go through a phase of collaboration or co-creation. And then once they've co-created, it's all about the scale. So we're really in that third element now, the scaling part. So our relationship with Absa is changing from them being merely a shareholder in our business to now being a much bigger customer of the services that we have. So they're going to now be directing their SME audience onto the RainFin platform for these short-term, medium loans.
So how's this going to work practically, Eugene? Are you going to be giving customers away to RainFin, or are you still going to be vying for their business?
Yeah, so I think it's a maturing of us. I think the Seeker Fund, the initial investment in RainFin was around what we saw in the future, how we think we saw lending would migrate into a marketplace. I think the relationship now has gone from where it was traditionally just focused on retail. We've moved into the small, medium enterprise and the enterprise development space. So it's leveraging now what we have in that space in terms of clients and hoping to provide them with an experience now that's a lot cheaper and a lot faster in terms of the experience they've had to date. So it is directing a portion of our portfolio, but it's also leveraging new level of insight we're able to gain via using RainFin's scoring models, the platform, and how the client experiences that process.
You don't change your model though, do you, Sean? It stays the same, so everything still applies. You're just getting more customers directed your way.
So I think it doesn't change at all in the context for Absa. So Absa has been a lender on our platform for quite some time. They've been buying loans on the platform and investing onto the SMEs we have been originating. So they're now going to be sending more SMEs, yes, to our platform, but they're also going to be hopefully buying more of those loans. So for them, it's just a way of them originating these loans much cheaper, much faster, and much more efficiently, especially for the customer user experience for that SME himself. He gets a great experience.
Will this add to the competitiveness of the pricing on the platform, do you think?
We very much hope so. So ultimately, in this context, the more demand there is for loans, the more we can go to our investors or other investors and say, look, we have the demand, come onto the platform. Because how the platform works is that the SME's loan gets put on the marketplace, and then investors have the opportunity to bid for those loans. So yes, here we still always have had the Barclays Africa Group as a whole as one of the investors, but now we also have many more others that are coming onto the platform. There are already around 300 investors on the platform, so there's quite a large opportunity for SMEs to get loans.
And does this change your risk profile at all? Using their credit scoring methodologies, would you be able to take more risk perhaps? Because we are talking about unsecured loans, aren't we?
That's right. So look, we're already in the business. We are doing unsecured loans itself. Our calibration with our scorecards related to what RainFin does doesn't highlight any difference for ourselves. I think the important bit around the relationship with RainFin is around what it means to have open innovation. So we've invested in the platform. The platform's been built out. We think it's at a level of maturity where we can begin to scale it. So at that point in time, it takes a little bit of a leap. Are you going to go use this open innovation now to create a better outcome for the clients? And that better outcome is the underlying loan, the loan request gets democratized. The people who participate via the auction process, who come in to price the loan, it ultimately ends up with a lower outcome for the client. But it does mean, related to that SME loan, there's a level of risk sharing in terms of we may not be funding the full amount of the loan. And the risk for us is the entire loan may be funded by someone else as opposed to ourselves.
Take us through the benefits that you're getting out of this though, Eugene.
I think the benefits for us is the process around the creation of the information needed to understand the affordability, the determination around whether one lend. This tends to be a tedious process. It allows us to avoid leveraging your traditional bricks and mortar to undertake these processes. It also allows us to easily direct those clients into a digital online portal where we can undertake that onus. So we get to leverage a lower infrastructure cost in terms of how the origination occurs, and we're able to dilute our participation, or at least create what we think is a fairer outcome for the client in terms of where that loan is priced.
Do you also measure the impairments, perhaps, or the bad debts that are going through your platform? Are you seeing any variances there?
Of course. It's very important for us to have a portfolio management approach. So these first 2 years that we've been working with Barclays now, since 2014, have been about that exactly. So Eugene mentioned the collaboration of the scorecards, which is very important for them. It's very important that they feel that the loans that they buy through our platform are not going to have any different risk profile to the loans that they would purchase. In this context, there might be applications that come in that might not fit their risk profile, which are therefore more appropriate for other people who have a different risk profile and clearly different pricing. What it means for the SME, though, is there is one place where you can have access to investors who have different risk appetites. What we're hoping there is that we'll have organizations that have got different pricing as well, like development agencies who have lower cost of capital and don't need as quite high returns. That's going to be interesting about how those development agencies will compete with the banks to fund this nice pool of SMEs that are now getting originated on the platform.
Percentage of buyers and sellers that don't actually meet up on the platform?
So at the moment, we are actually really lucky in the context that our investor demand is oversubscribed to our borrower demand. So we are at the moment filling almost 100% of the loans on our platform. What the question that you should be asking is, are we letting all of the applications on the platform? And the reality is we aren't. We are only letting applications onto the platform that we feel are a good match to the investor risk appetite that we have on the platform. So yes, as we have more investors with a broader risk appetite, we'll definitely be allowing more people onto the platform as SME lenders.
And the type of SME borrowers that you're directing towards that platform, what sort of profile would you be looking at in a customer that you would want to go the RainFin direction?
So I almost would say it's a full suite we're looking at. But we do set thresholds. Those thresholds are around $1 million or less. We're specifically looking for clients where we're able to target where they've been leveraging their corporate supply chains in terms of getting funding, because it gives us a better trajectory on their history around past performance against contracts, invoices, etc. And then your traditional SMEs that have come into the branches around that funding, the ability to turn around quicker, I think that's an important bit. And then all the way down to your lower end of the supply chain who do struggle around finance, we're able to now go and bring, as Sean mentioned, agencies on boards who may have a different risk tolerance and may actually be looking to focus on a social construct that's not really being catered for, which is businesses that may be new to the business, don't have the longer track records, meet the right credentials related to empowerment, meet the right credentials related to what they're able to prove in terms of their business and what's been done.
Well, that sounds very exciting developments, and I'm sure we'll be chatting about it again, but thank you very much for coming through today.
Thanks for having us.
Sean Emery, of course, CEO of RainFin, and Eugene Boyson, Chief Innovation Officer at Barclays Africa.
The next level of remote control, the display key. The all-new BMW 7 Series, the exception rules.
There's a reason big businesses trust us with their business. We're a top 100 company ourselves, so we understand what it takes to build a successful business, and we'll do everything we can to protect yours. Santam, insurance good and proper. Think new.
Thank goodness it's Friday. Time to down those pre-budget tax drinks and stock up the bunkers for Provin's looming blitz. This is the week that was. I'm Juliette Levy. My co-host is Simon Brown. And joining us for our weekly romp is Sasfin Securities' David Shapiro. David, it's been a lot better this week, or certainly the mood in the market has been better this week than last. So why is everything so much nicer now? It is
schizophrenic, but I think that investors globally are beginning to realize that there was more fear in the market than fact. You know, when we start to unpack results, even though they haven't been great, they're still moving forward. You know, if we look at some of the economic data that's coming out, it's not recessionary. You know, it's not 50% recessionary. I think that's what the market was building in. It might be 20% recessionary, but not